Hi there. In today's market focus video, I want to share with you my thoughts on the current sell-off we're experiencing in the stock and the bond markets, as well as the factors I see driving this volatility. Now, just less than 2 weeks ago, the stock market indices across the U.S. managed to reach fresh all-time highs, but since then we've experienced a pretty significant sell-off. The NASDAQ index has dropped by 10%, officially putting that index into correction territory as of today, while the broader market index, the S&P 500, is down 7% from its peak. Now, this volatility from my perspective did not come as a complete surprise. In fact, if you watched the video I did on September 12th, I actually laid out the expectation that we would likely see higher volatility in the months of September and October, as these 2 months have historically represented the worst 2 months in the calendar cycle, especially so in a midterm election year. In the next video I did on September 26th, I also expressed concern about the fact that the performance so far this year that has fueled the stock market's gains has been largely concentrated in a small number of stocks as compared to a widespread market rally. And those stocks have been primarily in the technology sector. And I suggested unless the market gains broaden out, if the technology sector weakened, it could take the rest of the market down with it, which is actually what we're experiencing as we speak. The other key factor I want to highlight for you driving this volatility is that investors have become increasingly concerned about the possibility that the Federal Reserve, in the interest to thwart inflationary pressures, could raise interest rates too much. And then in doing so, they could choke off the fuel that's been helping grow the economy so successfully for many years. In fact, this concern was expressed by our U.S. president yesterday. And investors are reacting to these rising levels of fears, I think, irrationally, because today, folks, the fundamentals of the U.S. economy are incredibly robust. Unlike we've seen for many years and even decades, especially in the unemployment market, which is at the lowest level we've seen in approximately 50 years. Today, we don't see the conditions that would coincide with a recessionary slowdown. And if we did have that environment, we would be concerned that we would be experiencing the beginnings of a bear market, meaning a decline of 20% or more. That is not the case today, folks. What I expect is that investors have overreacted to some bits of data, and ultimately the investors will pull back from these expectations and the market will adjust back in the upward direction. That's the base case that we see today, but we'll continue to assess the data as it plays out from here and keep you informed.